So as Dr. Enzer alluded to, I will be kind of introducing everyone to both the blockchain kind of more generally as it exists as a technology, and also what the primary application that we're working on for it. And I would like to kind of emphasize and reiterate that this is a very alternative investment is the way I would say it should be considered, kind of out past even hedge funds or private equity. Still very speculative, but still very early stage and exciting. So that's why I want to speak to you today on it. So a little bit more about our company, Topl. We were started in last October, and we have been building specially designed blockchain networks to handle merchant payments and personal transfers. And we are in the very early stages of what I will be talking about today, which is designing a system for global investment and trade. And the purpose of using the blockchain for these systems, as I'll go into in a little bit, is that they can be more secure, they can be more flexible, easier to design, and also more efficient and operate at a lower cost. So a brief overview on my talk. I'm going to kind of split it up into two parts. A brief intro on the actual blockchain technology, where it came from, what its uses are, why it's novel, why it's an improvement, and then I'll actually talk about the application that we're envisioning for it. We are envisioning, at least very briefly, I'd like to say now, designing a new system for foreign investment that can cut around a lot of corruption to make more effective investments and therefore provide the investors with more reliable and even higher returns. Talk about some of the advantages of this system as well as the potential hurdles, and then hopefully if there's a bit of time at the end, we'll have some questions. But if you have any questions, anything's not clear during the talk, just interrupt me and I'll clear it right up. So the blockchains, for all their recent hype and interest, they're actually a fairly new technology. They were first introduced back in 2008 by someone who we only know by pseudonym, Satoshi Nakamoto. He published a paper back in October of 2008 claiming that he had solved what was known as the double spending problem that exists in any decentralized distributed system. We'll talk a little bit more about that in a couple slides, but this was the major accomplishment of that paper, is solving what's known as the double spending problem. So a couple months later, he actually launched the Bitcoin network, and Bitcoin started being traded, being used, and it's actually gotten a lot of adoption since then. I'm not sure if you can read the axes, but it started off from no one using it to now about 200,000 transactions occur on the Bitcoin network a day. It's growing really fast, and like I said, there's a lot of interest in this space. To kind of make that interest kind of less fringe and more mainstream, in 2013, the blockchain was extended in its capabilities to allow for legal contracts, business logic to be implemented onto the blockchain so that trades could happen, stocks could be put on it, bonds could be put on it, any sort of financial instrument you want. This was accomplished in late 2013, and since then, we can see a list of kind of some of the major companies that have invested in this space. We see the major credit card providers, we see major banks, we see the Chicago Mercantile Exchange listed as well. So there's a lot of interest from very established financial players, in addition to all the startup interest that this technology has received. So in order to know what a blockchain exactly is, it's nice to be able to start with a point of comparison. And that point of comparison can come from how we traditionally track balances, how your bank account or how a stock exchange keeps track of everything. People submit trades, people submit transfers, balances, etc., but they are all routed through and verified by a trusted party. The bank's own servers, the stock exchanges' own databases, what have you. This is a great system if you can trust that party to always be operational, always be correct, and always be trustworthy. Though that's not always the case, especially if you want to deal in multiple jurisdictions, multiple countries, something like that. So people for a long time have been interested in making decentralized ledgers, where we can still have people talking to each other and storing data, but without any privileged party, any privileged computer being in charge of everything and saying, yes, this is okay, no, this isn't okay. So by removing the single point of trust and failure, we have a system that should be more flexible, can exist in more nebulous environments, and things like that. We have a problem, though, once we take away kind of the central authority in a system. With the bank, say you have $10 in your bank account, and you try to send that money to 2 different people. The bank can quite easily tell you, no, wait, stop, you can't do that, because they see and approve all transactions before anything else can happen. But in a decentralized system, when we're removing kind of that central party, we don't have that luxury anymore, and we might have a situation that we have here where Bob has $10 in his account, and he manages to send it to both Alice and Charlie without the other person knowing that that money has already been spent. So this was the major problem for decentralized networks that Bitcoin originally solved, that Satoshi Nakamoto proposed a solution to. Before we get into the solution, I guess it's probably worthwhile to spend a little bit of time elaborating on how exactly this might happen, because it might not be clear, at least at first pass. So let's, for instance, say that one of those transactions has a number of, call it 1812, and the other transaction, this one to Charlie, has a transaction number of 1813. Since all the computers, since everyone in this network is a different distance apart from each other, it's completely possible that some information gets to me before the other information gets to me. And if you're somewhere else in the world, your order might be reversed. You might see transaction 2 before transaction 1, for instance. So we end up with a situation like this, where we have some computers that think Charlie got the money first, and some computers, some people that think Alice got the money first. Obviously, money can only be spent once, so this is a problem, and the second transaction needs to be discarded because that money's already been spent. But now we have different computers on one network, and all the computers on a network are supposed to agree with each other, but here we see some people saying Charlie got the money, some people saying Alice got the money. This is clearly an issue that needs to be resolved. So since we don't have a central party to decide these issues, we have 2 primary other ways that can be used. One, all the computers can simply take a vote. It could be a majority rule system, or different people can have different votes based on experience or what have you. That's one approach. The other approach is we can have a race. And once a computer gets a new set of transactions, they all start racing to solve some really hard math problem, whatever that math problem may be. Anything pretty much that can be computationally solved. And the computer that solves it first, if I'm guessing my next slide right, I'm going to say this computer can solve the problem first, and then its record becomes the official record, and Alice gets the money. And that's what the system portrays, that's what is written into the history of the network, the history of the database. So this is kind of where the block shows up in blockchains. Transactions, as someone wins a race, get added and cemented into the history of the network. So that's a brief overview of how the blockchain works, and some of these advantages and disadvantages will fall out of that previous discussion, but some are kind of further afield that we're not going to have time to get to, but I'll at least mention them, and we can talk later if anyone has a question as to how they emerge. But as we've already talked about, one advantage, possibly the primary advantage, is there is no single point of failure. One computer, one data center going down is never going to take out your entire network, which can be a huge advantage because there have been recent cases of glitches at a stock exchange bringing down trading that could theoretically be avoided if the network is spread out more geographically across completely isolated computers. something, unfortunately, we didn't have a chance to mention is the blockchain is primarily a network, but it can also be used as kind of this business, this transactional computer that can actually do the simple financial math involved in a bond, what's involved in a bond, what's involved in a stock, whether that be the ownership or the interest of the coupon, what have you. All that can actually be taken care of in the same code, in the same network that all the computers are using to talk to each other. So for development costs and purposes, this is a huge advantage because you're not linking databases to your network. Your network has its database built right in. Similar to not having a single point of failure, they also don't have any reason to have trusted parties if you want that stock transfer to go through or that bond to be paid. Everything is taken care of by the blockchain itself. The money is moved automatically based on the rules written into it, based on the contracts entered into on the blockchain itself. So it's nice, there's no need for trusted parties outside of the system when time comes for contract execution or something like that. The last primary advantage is once something is on the blockchain, once it's been approved and is part of the history, it can't be changed without everyone seeing exactly how it was changed, when it was changed, and also what the original value was. So in that case, it's great for things we want a really solid record of because the blockchain is immutable. Well, these advantages all seem great. Nothing in this world is without its disadvantages. So the two primary ones for the blockchain are, since we're using a lot of different computers, and since we're not trusting any one computer to hold all the data, all the computers need all of the data, which, just because of replication, can be very, very expensive in terms of storage. So the blockchain is not a place to back up your photos, is essentially the takeaway there. The other disadvantage is the way blockchains treat transactions. They're kind of chunked and then verified and put onto the history. They're not really ideal for something such as high-speed trading where you try to gain advantage based on your position in the network. You could do payments, things that settle in even fractions of a second, but anything more than a millisecond, you're really bumping into the kind of conceptual limits of this technology. So it's kind of a no-go for high-speed trading at least. But those two disadvantages completely aside, there's a lot of interest. There's a lot of very easy to understand uses of the blockchain. The first one that's probably gotten the most interest are simplifying and unifying interbank settlement systems. So right now we have systems like the Fed ACH system, CHIPS, FedWire, and then for international transfers, there's the SWIFT protocol. All of this settlement, all these trades that happen between banks, all this can be put onto the blockchain so things can be automated better. All the banks can see more easily what transfers are going and when. So two companies working on this are R3, which is actually forming a consortium of actually almost all the major banks now. Citi, Chase, any large bank you can think of has at least started talking with some of these companies about how this might be implemented. Another company actually headed up by a former Chase executive is Hyperledger. In addition to interbank settlement, blockchains are also being considered for post-trade processing. So in derivatives market, in currency markets, something like that. UBS and a startup they have partnered with are looking extensively at the blockchain to be able to simplify kind of their post-trade execution environment for both ease of use of the system and also more liquidity coming into the system simply because trades clear up more quickly. Moving a little bit away from finance, some more radical, some more interesting ideas with the blockchain are using them to have decentralized prediction markets, which is essentially a case where you can have a bunch of people betting on an outcome, trying to predict an outcome, and through a sometimes contentious principle called the wisdom of the crowds, in certain cases the kind of preferred answer might converge to the true answer, what's eventually going to happen, possibly faster than some expert opinions or maybe even the news cycle. So they can be used for prediction markets as well, which is rather interesting. Two very big names in technology that you'll see here, Samsung and IBM, are considering using the blockchain for the network component of their Internet of Things, their smart devices. So if you have a smart meter in your house watching your power, it could theoretically automatically pay your bills as well. And that's what Samsung and IBM are taking a look into. All of these are very interesting ideas, but even if all of this comes to fruition, even this I don't think would justify the amount of hype, the amount of interest, and quite honestly even the market cap of all Bitcoin in existence right now, unless there was something else that the blockchain could do. Something that the blockchain could do that couldn't be done any other way in a very large market with a very large improvement over how things are currently done. And obviously, since there's still time left in my talk, the answer to that question is going to be yes. The blockchain can do more than this. It can allow us to do something very groundbreaking. So the title of this talk, that I might have been too brief on the first slide, was the blockchain and global investment. So now we are to the section of the talk where we are looking at the blockchain for global investment. How it can be used to simplify, to make more reliable and more effective the process of foreign direct investment. So before saying this is the big revolutionary thing that the blockchain can do, first might be nice to check that this is something worth doing. So being kind of an investor-focused conference as this is, it's good to take a look at why investors might want to invest in developing economies, put their money abroad. Well, in this granted oversimplification of things, we have about 6 or 7 billion people in developing economies, about 1 billion people in developed economies, with a very large difference in GDP per capita. Now, it can be a point of contention how much this number can increase. Can it actually get to 40? Can it go higher? But the brief takeaway is you have most of the world with at least a fair amount of room to grow. And if there's a fair amount of room to grow, it means your return as an investor can be both large and very sustainable, which oftentimes in our heads seem like contradictory ideas, but if we could put them together and make them play nicely, it would be a big bonus. So that's the primary motivation for why we would be interested in improving foreign investment, because it can have some major payoffs. But obviously there are also concerns for investing abroad. It's why more people don't do it. It's why you have to be specialized. It's why you have to have a good risk tolerance to do it, especially in some more unstable areas. And this comes down to, at least partially, poor business and regulatory environments, or at the very least, regulatory and business environments that we are not familiar with, that are, quite frankly, foreign to us. But even more objectively, we can see what we have here is a lot of publications, a lot of groups. I'm getting a weird face from one of my colleagues because you can't quite read the axes, and I apologize about that. This is a composite business environment rank. So data taken from the World Bank, data taken from The Economist, the World Economic Forum. They rank the ease of doing business, the rule of law, things like that in different countries. And as we can see, because this is GDP per capita on this axis, there's actually a pretty good relationship between the more developed an economy is, the better its business environment. So it makes sense that these areas way over here that could offer the biggest returns, at least potentially, are also the riskiest places to put your money because of legal concerns, political concerns, what have you. Another concern is investing in US dollars, investing in euros is nice and easy. I can move into dollars, out of dollars from stocks or bonds, and I have pretty good certainty that the value of that dollar is going to remain pretty solid, pretty reliable. Obviously, we know that's not the case for a lot of developing economies. There are runs on banks, there's issues of hyperinflation, and not only is this a problem for the investor, but it's actually also a problem for the country experiencing it. I have some data here that I've kind of synthesized and gone through, but there's also references by any central banker you want to list. Came across a couple papers by Ben Bernanke on this issue of the amount of inflation that a currency undergoes and kind of trying to correlate it to, connect it to what the economy is doing. So we can see that everything less than 15%, everything with a doubling time in the lifespan of 15 to 20 years, you've got pretty good growth, 4% plus. Things don't get too bad as your doubling horizon drops down to about 2 years or so. But once the price of goods starts doubling every 2 years or even faster, it becomes fairly intuitively a major drag on the economy, with us seeing 1.4% growth. And these are the areas where you have a high potential for growth because you have a low GDP, but at the same time, you're not seeing the growth because very high inflation is very bad for business. And the third and final concern for investing abroad is these companies are very far away. They're culturally different. Their language might be different. If you want to be a long-term investor, it's more difficult to do due diligence on a company like this than it is a company down the street or a company registered here with the SEC. Due diligence, wow, that's a hard word, becomes much more difficult to conduct effectively. So we have all these concerns that stop a lot of people, and rightfully so, from being willing to move their capital abroad without, like I said, a really good risk appetite and a lot of experience. So what we want to do is we want to keep the motivation, keep the advantage of investing abroad while either removing or at least mitigating the concerns. And at Topl, we're proposing to do this by taking the blockchain and adding it to what we're calling production-based investment. And just 3 bullet points right here before we get into it. It kind of stands on these 3 core ideas. That the system's based on direct investment in the future production of a foreign business, that contractual agreements entered into can be enforced by the network itself. So returns are enforced by the network, goods are moved by the network, etc. And lastly, that the medium of exchange, what you're doing business in, is not whatever that country's possibly unstable currency is. It's kind of this composite currency. It's actually more of a script to return to kind of the roots of what a currency really is, that's backed by a basket of commodities. So the pieces of this network, the actors involved in this network, fall into 3 groups. We have the producers, those companies in developing countries that are seeking investment for projects, be it farmland, be it mining projects, be it clean water projects, etc. We have the locations where the goods will be sent, and these are also the entities that not only they collect the goods as they're produced, they're also the ones issuing the commodity-backed currency to the producers, and they're kind of the central spoke in the network, as much as a blockchain network can have a central spoke, I would guess. And third, what's probably of most interest to the conference today, is where the investor fits into this space. And an investor in this space, it's not so much you're playing the market as you are partnering with a business and you are obtaining the rights to some of their production in exchange for carrying the risk of their production falling short. So it's kind of a very small business model type of investment where it's more of a partnership and you can reap the upside while covering the downside, very simply put. So now that we've got the actors, let's see how they all work together. So everything starts with, as it does in business, with the person who wants to produce something, who has the idea. So in this case, it's a corn farmer. I'm from the Midwest, so we're going to make this a corn farmer. he enters into a contract with either one investor or a group of investors. It could be a pool as well. And together, the farmer and the investor pledge that they will produce, let's say, 10,000 bushels of corn, and that it will be delivered to the port in whatever the time interval is, let's say 9 months. So once this contract has been signed, verified, and sitting on the blockchain, by the way, digitally signed, so we don't have concerns like that, the port issues this currency to the farmer that can be used for actually producing the crop. Their fertilizer costs, their seed costs, labor costs, etc. Obviously, this is a specific example and can be generalized to any other sort of production as well. So then 9 months go by, and one of two things can happen. The farmer could have either produced more or have produced less than the original contract was for. Let's say the farmer had a good year and he ends up producing 11,000 bushels of corn and shipping those to the port. The port, in exchange, is now going to issue 1,000 units of that currency. For the purpose of this talk, I've named them yields, to the investor. And that money goes to the investor because, we'll see in the next case, they absorbed the downside risk. So let's say the farmer has a bad year and only ships 9,000 bushels of corn to the port. There was a drought, there was a flood, what have you, so they fell a bit short. So now that the investor, since they've entered into that contract with the farmer, owes to the port the difference. So they pay the port 1,000 yields. All this taken care of and executed on the blockchain. So having laid out the system, it's worthwhile to ask, why is this an improvement? Why does this make it more likely that someone would be willing to invest in a risky situation, a risky political environment, or something like that? So for producers, the benefit is fairly obvious. In a case where you might not have collateral to go get loans for your season, for your new mining project, or anything like that, you can use your future production as collateral to go get essentially a loan that you wouldn't be able to otherwise. So that's pretty clear, pretty obvious. For investors, this offers a system, since there's no use of any country's currency once we're in the system, we don't have exposure to foreign exchange markets where I could get a really good return, but it could be wiped out because I need to get those rand or anything back into US dollars or euros. And then kind of just general benefits that both parties receive is by having contracts enforced and executed by the network itself, we can ensure that both parties stand up to their side of the agreement. So issues that we might have if we don't trust that a licensing or a regulatory agency is going to do the work required to guarantee enforcement, we have the network to take care of that for us. The other bonus we get addresses the due diligence concern. By having the entirety of the history of all transactions, all investments on the blockchain, everyone knows how everyone else has acted. So if you're an investor, you know how that producer has behaved in the past, and vice versa for a producer. Or if you want to go in an investor pool, you know how those other investors held up their contracts. So having outlined the system, it might be nice to kind of see it again in a little bit of a different form, broken down by the roles and responsibilities of each type of party. So, as I said before, everything starts with the producer. When they say, all right, I've got this new mine, I've got this new well, or anything like that, how much do I think I can produce? And once I determine that, I start entering into talks and enter into a contract with an investor and say, this is what I think I can produce, this is what I hope to produce, so this is what I think your upside might be, and this is why I'm not going to fall below that target. And once the producer has the investor on board, they pledge the production to the port, and then once that's been done, once crops have been taken in, once the oil well has been producing, these pledged goods are delivered to the port. The investor, the flow looks fairly similar. You can either approach a producer or have a producer approach you, evaluate them just like you would with any other business deal, and choose whether or not to enter into a contract with them. And once that contract has been entered into and the pledge for the goods has been made, you can either get the excess or pay for the deficit depending on how well your producer performed. And then lastly, these ports that can be scattered in different regions and run as collectives, their responsibilities include actually issuing the currency to whatever producer has pledged their commodities to them, and to issue more or take receipt of what might be owed if production falls short. So they would be responsible for collecting any excess currency that might be outstanding if a production run wasn't quite as good as expected, or issuing more to purchase whatever excess commodity was delivered to them. So in the simple case with the corn farmer, kind of made sense that bushels of corn could map onto one unit of currency very nicely, but the system wouldn't be very useful if it could only work with a single currency basket, because, well, that would be unstable, that would be less useful, and you could only have fewer people involved in the system. So it can be quite easily extended to multiple commodities, anything that can be treated as a commodity, really. And the way this is handled is as follows. Based on the demand for the actual good, the number of currency units, the number of yields per unit of that commodity can adjust. So if everyone wants a lot of corn, then there's simply a little factor attached to the farmer's number of bushels that tells him how many currency units he gets. So if everyone wants corn, for instance, he's going to get more currency units per bushel of corn. If there's an oil glut, you're going to get fewer units of currency per barrel of oil. Nice and simple, thankfully. So that's the extension to multiple types of commodities. It can also be extended to different types of producers. Some producers are going to be more reliable, some are going to be new and inexperienced, and the system should treat them differently, just like any market does. And this is taken care of by the actual contract negotiation between the producer and the investor. So let's say we've got a really great mining company. They always hit their targets. They always magically seem to produce more than they expected. They can go to an investor and say, guarantee my risk, put up the collateral, what have you, but I still get 20% or some number of my excess. And if it's a good enough producer, the investor will say, okay, yeah, because I think you're actually going to produce 150% of what you say you are, so sure, the first 20% can go to you. So that's how we can deal with new producers, old producers, larger, smaller, anything like that. So one question that probably is bubbling a little bit is, why do we need the blockchain for something like this? Why can't it just be done in a more traditional sense? Well, this is most easily answered if we say, okay, suppose hypothetically we're going to do this system but not have a blockchain. So then there's several things that would need to happen that I believe are infeasible. So someone would have to be managing and controlling the network and all the assets, and the issue is, people in different countries, I'm going to want my regulatory agencies to control it, you're going to want your regulatory agencies to control it, so there's a disagreement there. Contracts would have to be enforced by third parties, so either a foreign regulator brought in, or the regulator in that country that an investor may not deem to be reliable. The business logic and contract logic would need to be linked to the network somehow. Obviously this can be done, but this makes the system much more complicated. And now, possibly the biggest issue is all the records, every trade, every investment those are no longer immutable. They can be changed, they can be tampered with if someone gets into the system. And this is really important because if I think I'm buying a blue chip stock, I don't want to realize that I just bought something off the penny sheets. And this is the same principle. If I'm certain that your history is your history, then I'm more likely to trust that history and use it to inform my decisions. So what we can take away from this kind of is a summary slide. There's advantages, but again, with everything, there are major hurdles. So this system offers the opportunity to have foreign investment in a stable and fully commodity-backed currency. All agreements can be counted on, even when laws and politics can't be. And this system can be highly flexible because of its design on the blockchain, and it can be applied to many commodities, many types of commodities, many levels of producers. Before you ask me why I haven't done this just yet, I'd like to introduce you to the considerable hurdles. One might be kind of the most natural, the one that even a great blockchain system can't remove. Foreign investor, a foreign business, we have things like language and cultural barriers that are always going to exist and just kind of come with the territory. More technically, the system requires initial capital, initial partners to buy in order for this not to be seen as hugely speculative and therefore kind of undermining the whole stability purpose of the currency. Going along with initial adoption, if a coal mine is going to want to use this system, they're going to need to either be able to buy something with that currency or at the very least exchange it for something they can go buy with. So it either needs to be adopted at least minimally, or more likely markets need to open up that would go between this yield currency and something like $1, a euro, or something like that. So that concludes my talk. Thank you again to the Eubanks for sponsoring this event, to Coffees and Rice University for putting it on, and to Dr. Enzer and Dr. Dobelman for inviting me to speak to you today. So thank you.